Okay, testing. Anybody out there? Let's see. Find out if anybody can hear me, and then we can get going. All good. Okay, thanks, Moses. All right, so now let's try the video part and see if that works. Let me know when you can see something happening. Oh, the site keeps crashing. We've got the computer guys working on it. Something keeps going wrong. And I don't know what it is. So currently we're off. I wrote all this stuff this morning and then it crashed on me. I lost everything. So very annoying, but we'll see if we get it fixed. Doesn't look like it though, so we'll just have to wing it and talk about the market. And how is Mr. Market looking today? Whoops. Can anybody see the screen? Do we have any response on that? As nobody said they can see anything. Not much point in doing it if nobody can see it. Wow. Oh, good. Okay. Thank you, guys. All right. So where are we? Our big comeback. Look at this. Up 2%, 2.25, 3.5% on the NASDAQ. Holy crap. 1.05 on the Russell. Oh, come on. 3.35%. Oh my God. This market is crazy. That's all right, though. This is why we balance our portfolios, because we're not really picking a direction. Excuse me, I'm having lunch, so I'm dealing with all this crap at the same time. I just realized tuna salad is not conducive to talking. So, and in fact, that's one of the reasons we decided to make Tesla a big short, is because even if the market kept going up, I still thought Tesla was going to crash. So we weren't depending. So here's the logic for Tesla. If the market crashed, there's no way Tesla is going to hold up while everything else is going down. So it makes it a good hedge. Even making it a better hedge, even if the market kept going up, Tesla was so insane that it was going to crash anyway. So we could win when the market goes up, we could win when the market is flat, we could win when the market goes down. Unfortunately, it went really far against us at the beginning and hurt our short-term portfolio, pretty much wiped out all our profits for the year, but now, boom, they're back. So now the short-term portfolio is up 350% again, but we still have 434 minus that, so call that 400 and 133. So we still have more than $500,000 worth of protection in this Tesla position. My biggest problem now, if it goes below 300, this thing can cost us money, but this 133,000 right now, it's all premium, right? Because it's a 300 put, Tesla's at 350. That means that is 100% premium, that 133,000. If Tesla stays flat from here and stays around 350 or even goes to 300, as long as it doesn't go below 250, we're fine. If it doesn't go below 250, we're still going to make most of that 133 back. Isn't that crazy? So, and on this side, of course, obviously anything under 380 is going to be a winner for us. So we got nervous when Tesla went crazy on us. I need a bigger chart. Here we go. So, and I don't mean nervous in a bad way. I mean, we got nervous in that at a certain point you got a hedge. So we sold those 300 puts when Tesla was up here at 400. And the reason we did that was because, God forbid, it went past 5, we would have had to roll again. But then we would have had the money from the 300 puts, which was $78,000 to put towards the roll. So the logic on 8:21. The logic on August 21st, which is what I said right here. So the logic on August 21st was if it goes above 400, then clearly then the puts expire worthless, and we've got $78,000 to mitigate the damage of it going up. That was why we did that. And if it went past 500, we would have sold 500 puts or 400 puts, and we would have kept selling puts to pay to roll the short calls higher. You got to mitigate the damage. Now, hang on a second. Well, that didn't work. Okay. So you have to mitigate the damage on the way down, on the way up or down. We figured it's going to stay in this channel, and it will resolve itself somewhere in the lower end of this range, most likely. Hopefully not below 300. Even at this moment, though, honestly, I'm expecting Tesla to start flatlining down here. If it does, we're going to keep it, and if it doesn't, we're going to be thrilled to escape. Just, you know, this isn't a loss. It's 147,000 here. We're almost even on the overall position at this point. All right, we've taken some losses in Tesla, but now we've made some gains back, and we're probably, you know, if we have to, we're just going to take it off the table and be done with it, frankly. You know, our big position is the short 380s. I don't think for 1 second it's worth 380, but on the whole, if we cash this thing out now, we're in good shape, because, especially because the long-term portfolio is still up, as far as I know, it's still up 100%. Yeah, so the long-term portfolio is up 104%. So our hedges are up, our hedges are up 350%. Our longs are up 104%. So that's 1.45 million. You know, we're really at the same place we were. When did we? Oh, that's not the S&P. We're really at the same place we were back in. It was Memorial Day, right? That's when I got panicked. So right about here is when I decided I was too worried about the market. And we parked ourselves pretty much in neutral through the summer, because I thought the reopening was a mistake. I thought it wasn't going to go well, and I thought it was going to be a terrible outcome. So far, it has not been such a terrible outcome, but we have successfully been in neutral. I believe our portfolio is about where it is now the whole summer. We parked it in neutral. It's still in neutral. Now, neutral doesn't do us any. Neutral is fine if the market is neutral, and if the market's basically flat and we're flat, so what? Especially because we're protecting phenomenal gains for the year. If the market goes down and we're flat, even better. Okay. The only annoying thing is what was happening is the market was going up and up and up, and we were flat, and that was kind of annoying. All right, but now we've had a correction we expected. I don't think the correction is done. I think we've been saved by TA down here, hitting this line, which is what, the 50 moving average, basically. So, you know, we slammed down, we had a 10% correction. We stopped there, hitting support. Now we're going to go up here. Now the question is, will we clear this line? And that's that 3420 line that I talked about this morning that we've been watching. That's our 5% rule. That's the line that matters. Okay, these lines are just telling you what did happen in the past. The 5% rule tells us what's going to happen in the future. And we're seeing that 3420, the 20% line above 285. Okay, 285 and 20% is 3420. So the 20% line should be the limit of the upper range if this is a must-hold area. This is a true value for the S&P. Anything above this line, which is why it's called the must-hold line. See how it's holding? See how the must-hold line held? So see how the must-hold line held here? That was actually a good telegraph, except then it crashed below. But so the must-hold line held, and as long as it holds, you're still in a bullish rally. Even if you correct to the must-hold line, if it then holds, it's still bullish. We would be buying like crazy if this holds. All right. And what's this line down here? What happens? What's 28? Calculator? I can't do math. Yeah, I am getting older. Seriously, I used to do this in my head. You guys go to some old webinars, and I used to do all this in my head. I never used to use a calculator. Times 0.8. So 228 right down here. Oh, look at that right there. This is why in March we bought like crazy. So we hit the 228 line. What's the 228 line? It's the bottom of the range of 2850. All right, 285 or 2850 on the S&P is the 20% range. The 20% range goes from 3420 to 228 to 2280. That's our range. 20% up, 20% down. So all that's happened this whole time is we topped out at the 20% line, right? We topped out at the 20% line, went all the way down to the minus 20% line. But look how symmetrical that is, right? Back to the must-hold line where we hit resistance because it's the must-hold line. But we knew this. We knew this 2 years ago on the 5% rule. We knew this. We've known this since, I forget when, but it's a long time ago when we adjusted the charts. And then what does it do? Then it creeps back on a slow climb back to 20%. But why? Stimulus, 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 stimulus. Okay? All stimulus all the time. That's not sustainable. We're not going to be able to keep putting in stimulus at this kind of pace. And the economy has not righted itself. So just because we did do the stimulus and just because we move forward doesn't mean the economy is going to right itself and be perfect moving forward. So where was that? Yeah. And now it's more likely we're going to settle into the 10% range, which is more like here. Well, or it's exactly 285 times 1.1. 313. So this line, oh, look, and there's a line for that too. Isn't it funny how there's always a line for something? So it's funny how the calculations of the 5% rule, that's a 200-day simple average. So the 200 SMA showing the last 200 days is weighted down by this. And it's right at 315, basically, or 315, they're probably a little bit up there, but it's right at the point where we expect to be. Another 10% down from where we are now. Or 5% down from where we are now. Wait a minute. Nope. Yeah, the 10% line, that would be 5% below where we are now. So 10% up, 20% up, we're halfway to a correction, back to the 10% line. All right, and even so, still bullish. We hold that and we consolidate and start going back up, then we're into a nice bullish range. And the S&P will start recovering more slowly. But again, if we go back up only because of massive stimulus, only because of artificial means, that doesn't count. I mean, you know, you have to take into account that that's happening. In other words, if all right, if you have a car and you say, how fast does that car go? And if somebody was really scientific about it, they'd be like, well, by itself or with gasoline? Because without the gasoline, the car doesn't go very fast at all, does it? Unless you throw it off a cliff, in which case it goes 32 feet per second. But if it's on the ground and you want a 1-ton vehicle or a 2-ton vehicle to move forward, it is not going to go forward very quickly on its own. It only goes forward if you apply gas and if you turn on the engine and if you want to be more specific, if you're putting the gas into an internal combustion engine, turning the engine on, firing cylinders, connecting it up to all the crap that makes the car go. So only if the economy is firing on all cylinders, which is a good old expression we used to have that nobody knows what that means anymore, but only if the economy is firing on all cylinders are you going to get economic growth. If some of your cylinders are not firing, and it doesn't have to be all of them, but if some of your cylinders aren't firing, you're going to have a stuttering, not good economy. Probably a bad allegory because hardly anybody deals with this anymore. Back in my day, used to, you know, it's like we had to fix cars. I used to have a wrench in my car. I used to have to fix my own car. So, the thing, because we used to buy crap cars. That's another thing. Kids don't have crap cars anymore. We used to have the worst piece of crap cars that were deadly and falling apart, and we would have to drive them around because that was what we could afford. And I mean, I understand, obviously I'm privileged and my kids are privileged, but I mean, just generally, I don't even see poor kids driving around in crappy cars anymore. Everybody's got nice cars these days. It's really weird. So anyway, and my kids don't even know how to change a tire. They can, I have 2 daughters, but there's no way they could change a tire. It's just not going to happen. I used to break down on the side of the road and start taking my engine apart. But anyway, so point being, the economy is like an engine. It has to work well, and all the pieces need to be working, or it doesn't do anything. And that's the point. All right, so just because you have an economy doesn't mean it's going to go up. The economy could go down, be flat, whatever. If you keep putting fuel in it, though, and otherwise you can get things going, then it is going to lurch forward and do what you need it to do. And this is lurching forward. See how it's lurching? This is what you call lurching forward. So it's not going to go forward smoothly because things are broken. There's certainly every once in a while the cylinder fires, it's broken, and it does misfires, and the car stutters or stops or whatever. Every once in a while you turn your attention back to unemployment, into poverty, into medical costs, into student loan debt. There's certain things that when you start turning your attention to it, you go, ooh, that's really bad. That's not good. That's not good. But then 1 or 2 cylinders going, oh yeah, great. So tech is great. The Wall Street's great. The free money from the Fed is great. You have 3 cylinders working out of 6 or 3 cylinders out of 8 that are working. You might go somewhere. Might not last. The thing might burn out. The 3 cylinders you're counting on to get the entire engine moving may burn out because they have to support too much and do too much, and they start burning out, and then you're screwed. But economies are like that. That's how economies are. You have to have a whole picture. And unfortunately, right now, you have the government basically saying, I don't care what it takes. Okay? You have an engine that runs out of oil. You can still drive it, but you're going to destroy the engine. You start seeing black smoke coming out of your engine, the correct thing to do is just shut it off, not keep going. But that's what we're doing. We're running this economy on black smoke and flooring it in order to get to the finish line of the November election. But what happens after that? That's anyone's guess, because we are bankrupting this country in order to achieve this, and we're not even good at keeping that. So that's where we are right now. That's the overview. So this is only a very minor correction. This liftoff is typical of all the bullshit liftoffs we've had after a crash. Look at this day after a crash, right? Look at this after a crash. All right, all of a sudden everything's great, but not really. Then it comes back and goes down again. Then it comes back, goes flat. It's not great. Look at this one too. Up here, boom. All right, we fell from here, came down here, big exciting day, big huge gap up. But where are we a month and a half later? Same place we left over there. We have made genuine progress, 20% progress from 300 since July, but it's cost us a fortune. And now we're sending our kids back to school to boost the economy. The back to school economy is big. Teachers back on the job, students out there, everybody shopping for supplies, including PPE supplies now, because everybody's got to buy face masks and gloves and everything else, and disinfectants and everything. Didn't used to pack that in our lunchbox, but now we do. So demand. And we're working on some PPE supply stuff too with PSW Investments. And you do the math. 50 million kids need at least 1 mask per day. All right. So there you go. 50 million times 200 school days. So that's 10 billion masks. Things like that. Just, the numbers get staggering, right? All of a sudden, it's like all this incredible need for things. And then there's the gloves, and everybody's got to start wearing these gloves now, and all this other stuff. The kids won't wear it, I don't think, but you know, everybody in the school, the janitors, all the cafeteria people, the whole people, everybody's gonna have gloves on too. There's a lot of stuff that is obviously GDP will look better, or the sales, retail sales and stuff will look better, because a lot of things are being bought that weren't bought before that are mandatory. Anytime something is mandatory, it's good to be selling it, right? And we'll see how the economy progresses and what happens. But this is, again, it's artificial. It's not normal. It's not part of the regular economy. It's a different thing. The government's putting money in and spending money. And where are we at now? We're going higher or lower? No, so here we are, right at 34.20. It's exactly where we said we'd stop. So we'll see what happens. But, you know, if I'm a betting guy, I see this line here. I see this line here. So I say, hey, you know what? 28.2 was resistance before. So we say, you know what? Let's bet 28.2 on the Dow is going to be the top, and we make a short. And we could even make a short at 34.20 on the S&P, because we know that's the top. And that lines up with 11,005, well, not really 500, but close to 11.5 on the NASDAQ, and 15. You know, the Russell already is showing that it's probably too weaker than the other guys. You know, and of course, we want to look and see 2.5%. That's another good reason to short the S&P, 2.5% rule. It's a 5% rule, but you know, the 5% rule says 2.5% is a big move for one day. And the S&P is a real index. This is not a real index. This is bullshit. The Dow is bullshit. They changed the components. It's not even the same stuff it was. You can't go by it. It's useless. The NASDAQ, how's Apple doing? That's how the NASDAQ's doing. This dollar thing is totally broken. You know, but how's Apple doing today? Apple's up 5% today. That's an easy way to boost the entire market, right? Apple's up 5%, $6, adding 50 Dow points by itself. And oh, that's weird with the split. You have a lot more. You have a lot less effect from Apple because of the split on the Dow. And a 5% move on Apple, though, is huge for the. It's huge for the Nasdaq, which is basically adding 1% to the Nasdaq, because it's 20% of the Nasdaq. So 1/3 of the Nasdaq's move, or a quarter, is Apple. It's adding to the S&P, of course. It's probably 3%, 1.5 is probably about 10% of the Nasdaq of the S&P's move is because of just Apple. So Apple's having good days, boosting everything. That's boosting the Dow, it's boosting the S&P, it's boosting the Nasdaq. And that's a huge move by Apple. So of course the market's up. And that's, what's that? More stimulus. It's another way you stimulate the economy. Apple goes up, everything goes up. Let's see if we have any questions. Robin says, hi Phil, I have 5 WBA January 40, 47.50 bull call spreads. What would you do with them? Okay, so here's the thing. Now you don't have a price, but I'll tell you what it is. So trade all products. WBA, which I very, very much like. But unfortunately, she's got the 40. So she has the $40 calls, which are only $1.69. She has the short 47.50s, which are now 50 cents. Now, I don't know what you bought the spread for. I'm guessing it was certainly more than $1.60. And that's a shame. But generally with a spread, you want to roll the spread before the value of or the price, not the value, but before the price of the long calls falls below the net of the spread. So if you paid $3 for the spread, you should have been doing this roll when it was at $3, not waiting until it gets to $1.60, because now you're in trouble basically. Walgreens is not likely to bounce back quickly and save you. So what you have to do is you have to choose, and it's the same move whether you do it late or not, but it's just easier to do when you do it earlier, is you're certainly not going to pay any money to buy these back. At 50 cents, they're way out of the money. Why would you spend that money? But what you do need to do if you want to stay in the trade is take these 40 calls that are $1.69 and roll them to something more productive, like the I mean, you could do 40, and that's cost you $3 to move it out to 2022. I would not though. I would spend more money, and frankly, I would be here's what I would do. I would buy the $30 calls, which are 860. I'm just going between the two numbers. So these are 860, and I would sell the $40 calls. Yeah, 30, 40. Yeah, I could do that. All right, well, let me see a second. What's 35 is 6, and 45 is that. So that's like $3, and the other one is $4. I'd spend the $4. So I would roll to the 30-40 spread, which is basically 860 minus 330, let's say. So that's going to be, no, that's too much. No, I'm sorry, forget that. That's too much money. I wouldn't spend that. All right, so we're back to here. We're back to 3250 is 7, 4250 is 350. That's $4. Or the 35s are 6, and the 45s are 3. No, they're not really 3 though. It's going to be okay. All right, I do that one then. All right. So the 3250s, which are 7. Okay. The last sale was 7. Hopefully you can get it for 7. So the 3250s is 7, and the 4250s are at least 3, probably 320. So then if you're spending 320, so then you're spending 380 on that spread, let's say. On the nope, sorry, it's the 4250s. Yes, that's correct though. So let's say you're spending about 380 on the 3250, 4250 spread. So what have you done? You've lowered your strike considerably from 40 to 3250. You are now in the money. You spent you spent 380 here minus $1.60 credit that you got from the roll that you just did. So you're spending 220 of additional money basically. So for $2.20, what have you done? You've put yourself $250 in the money. So for $2.20, you're getting $250 in position into the money. You have a 3250, 4250 bull call spread. You still have the short 4750s, but the only way you would owe this caller any money is if your position is 100% in the money. So you would have another $5 coming to you practically from that position. So it's not very risky. You could then put a stop on half of your short calls to make sure that you don't get burned. But if you can do that and leave the open short calls, that's the way I would do it. If not, then pay the 50 cents to get rid of it and just stick with the spread. The spread ends up costing you, let's say you spent $350 on the original spread. Now you're spending $250 more, $260 more on the new spread. So now you spend $6.10 on the $10 spread. But you spend $6.10 on a $10 spread that's in the money, and now $42.50 is your exit for a profit. So either way, it's a very good adjustment. I would not, again, like I said, I would not buy back the short calls. I would put a stop on 2 of them at 50 cents. I'm sorry, they are 50 cents. I put a stop on 2 of them at 75 cents and a stop on 2 more at $1. So worst cases, I'd be exiting for $1.50 or so. I'm sorry, for an average of 85 cents to $1. But at least then I'm not paying too much. So if they keep going up, I'm going to keep buying them out, but I'll be in the money by that time. By the time you have to buy them out, you'd be in the money. And so that's how you fix a position like that. It's easier if I do it in the chat room though. So if you want to ask me something, I can illustrate it better in the chat room because I know it's a lot of if-thens to a thing like that. But that is a way to fix it. But more importantly though, this is the key. Had you had the 35-45 spread, all right, where you'd be now is those 45s, notice, are barely any more money than your 4750s. Okay. Let's see, the tuna salad or Corona. Hang on a second. All right. Pretty sure it's tuna. Had you things we got to worry about these days. Had you bought a 35, 45 bull call spread for 350, now the 35s are 350. So think about that. If you are then rolling your 35s, you're recovering 100% of the money you spent on the spread. Then you've got no cost, and you could roll into any other spread that costs 350. So let's say we reset our new target to be 40 bucks. So then we just take $6 plus 350 is 9 something, and I'd spend a little extra money, and you would be able to afford to go into the, let's say these guys are 10, the 27.50, 40 spread for, what did we just say, for 10.50, for $6. So spending $3 extra would put, not even $3 extra because you get 350. Spending $2.50 more would put you in a 12.50 spread, the 27.50 35 spread, that is nicely in the money. So you see the difference? Again, it's an academic exercise, it's complicated, lots of moving parts, but the concept is, if you make that roll while you're still able to salvage the net cost of your spread, you will then recover that money and be able to use it again. And you'll be able to use it in a position that's actually worth the money you're spending. You're buying $10 calls. And how much are you buying it for? You're buying them for the $350 investment you originally made, plus the extra $2.50 or $3 net of the spread that you're upgrading to. So for now you spent $6 net on the $10 spread. And if that goes down to $6, if these calls go down to 6, you roll it and do it again. But what do? You keep recovering your net cost. And eventually, hopefully one day, it'll come back for you. But the point is, if you make your rolls at the point at which you can still recover your net cost out of the spread, you will do way, way better. That's what you got to keep your eye on. It's how much net did I spend on the spread? Will I do it? So when I'm going through my portfolios, that's what I look at. I look at a spread and I say, well, this spread's not in trouble because, there's a good point. Who's in trouble? Who's in trouble? Who's in trouble? Avgo calls. Really? Minus 189%. How's that even possible? That's weird, isn't it? Oh no, it's a short call. Oh, there we go. I'm sorry. So that's not a good example. Net. None of our positions are bad. That's the problem. They're all so profitable. Gilead. All right. Okay, there you go. Okay. So good old Gilead is doing badly, or not well anyway. It's actually on track. It's actually at 65. We had a 65 spread. We were cautious when we entered it, but even so. So these calls are down 38%. But I don't care because the net of the spread was $4, right? I bought these calls for $20.50. I sold these for $16.60. So the net of the spread is $4. How much are these calls worth now? $12. Is that a problem? Of course not. I don't give a crap if this doesn't bother me. I will never pay him a penny. If I don't need to get rid of, if I don't need to change these, I'm never going to pay him. As long as they're worth more than $4, I'm going to win, right? So we're getting closer to the end, not that close, but we're getting closer to the end. And I paid $4 and they're currently worth 12. I don't care what that one's worth. It doesn't matter to me. I care what this one's worth. That's the one I own. I will make the money up to 10. So this is higher than I can even collect on the spread. But the point is, it's a damn sight higher than 4. So even though they're down 40%, the calls themselves are down 40%, I'm still fine. I'm exactly where I want to be because they're worth 12. I can't collect more than 10, and it's a damn sight more than 4. That's a profit. Okay? It might look bad to a casual observer who doesn't understand the options, but if you understand the options, you say, no, there's no problem with that. Here's another one. Here's Middleby. The 100 calls, oh, they took a hit. Holy hell. Okay. Oh, no, that's my fault. Oh, I'm such an idiot. We should catch those out. Do we not? Really? Nobody told me about this? Ugh. It's not that bad, but still, it pisses me off. We should have cashed these out when they're up here. Don't forget those. Those are left over from the old trade, and otherwise we're doing too good. Wow, look at this short call though. Minus 467%. Sounds like we're getting crushed, right? But again, we own the 30s. I don't care what the price of the 50s are. We own the 30s. We are 1,000 miles in the money on this thing. So those look terrible, but the net of the spread is 20 bucks. That's as much as we can possibly make. We should cash these out. There's no point. We can get 20 bucks for these things now. So why leave them on? There's no point to them. 20 bucks is the most we can get. I don't care what the apparent loss is on this. People get very hung up on that. I didn't really lose $75,000 and I didn't really make $90,000. What I did is we had I guess we did. That's probably how it works out. But I mean, we had a spread, the 30-50 spread. We paid $12 for it, and now we're going to cash it out for $20. End of story. The loss and the gain, they're all irrelevant. What's relevant is what happened, what really happened to our net. His Restoration Hardware, look, they lost 475% here. It always looks bad on what you're losing, right? But that's because we made money. Why did we make less than we gained? I'm sorry, why did we make less than we lost? Because we started with a higher number here. The base was higher. It's 50 versus 36. Doesn't matter though. It's a $40 spread. How much are we going to make right now? 33. Is it anywhere close to hurting us? Not even a chance that this is going to hurt us. So we're just going to leave it there until we get the whole 40. But that's what I do. So when I'm looking at the positions, I say, who's in trouble? I'm like, well, they're not really in trouble. I just do that. I go look at them. I'm like, nope, they're not really in trouble. And I go over here and say, is Viacom in trouble? I have a $60,000 loss in Viacom. I'm like, and look at that, 400% loss versus a 240% gain, almost double the loss percentage-wise. But that's because we spent $7 on the calls and sold the short calls for $3. Why? I was aggressive. I thought it was going to go much higher, so I took the 5 calls long and the $15 call short. Now we're at 28. So the most we can make on this spread is 10 bucks. How much is it netting now? 9 bucks. But it's so far in the money, I don't even want to pay $1 to get out of it. Oh, and here's speak of the devil. Here's WBA. We have the $30 calls. We already did a roll to put ourselves in $30 calls. We took less puts. The damn thing keeps going down. I'm sorry, we have the puts. We bought back our short calls. We're just waiting for it to go back up. But right now we're sitting on a pretty big loss on that one. But it's not the same situation because we're not in a spread. We're in the 2022s. We're at 30. And all I really care about is will we get back to $41, $42? Because we spent $12 on the $30 calls. We need $42 to get even. So we go back to WBA. I mean, obviously, this isn't going to tell us. WBA. This isn't going to tell us what it's going to go back to, but you can see it's not a very ambitious thing to say you're going to get back to 42. So if it recovers and if we do better, it'll go, we think 42 is realistic because we were at 60. We were obviously it was way higher than 60 at some point with stock charts. I can't believe how they get cremated, that company. WBA. Had a bad week, huh? I just picked them last weekend too. So I picked them here this weekend. On the weekend, I picked them here. And so they were what, 36? They're down $1. It's not terrible, but they're down $1 since we picked them. Repicked them. I picked them obviously many times because they're ridiculous value stock. So for years, they're trading here. And again, all right, again, back to fundamentals because we should be teaching this stuff. For these 2 years, let's say that they averaged about 60 bucks, okay? Fine. Now they're at $35. So I go to WBA. And I say, what did you guys do? How did you mess up so badly? Here's the income statement for the last 10 years. So for the last few years, they've been trading at 60 bucks. Well, their revenue was 117, 118, 131, 136. That's going up. Must be the profits. So the income went from 4.1, 4.1, 5, 4. Okay, that's bad. They went down to $4 billion. But that's not the only thing we know about them, right? We know that Walgreens merged with Boots. And they took on, and they did that thing with, and they bought a whole bunch of Rite Aids. So they engaged in a massive, massive restructuring. Very, very expensive undertaking. They invested in the future of their business. That's why their income after tax last year was $4 billion. Then, after doing that, after borrowing money, leveraging up, doing a merger and an acquisition in the same year, so big of a merger and acquisition that they were forced to spin off a huge amount of their Rite Aids that they bought, because they bought Rite Aid, then spun Rite Aids back off, because they were not allowed to have that many stores in the U.S. It was too much. They were way over the limit of what the U.S. government considered prudent. Because obviously, as you know, there really only is either Walgreens or CVS. But basically, in every town, you have a Walgreens and a CVS, usually right next to each other. So at least if one of them goes bankrupt, you got the other one. But you can't have Walgreens take over the whole thing and be the only drugstore, because then what happens is they go bankrupt and nobody gets prescriptions tomorrow. And I know you're like, yeah, supermarkets, but realistically, it's like, they're a drugstore chain, and we do need to have a place people can get their medicines. And really, do you want to count on the ShopRite pharmacy to get your prescriptions? I guess some of you guys do, but I mean, I'm personally would rather go where it's like, more of a staff for pharmacy and all that. Other than that kid in the smock, in the back of the ShopRite. So where are we? And I apologize if anybody is a ShopRite pharmacist, but it just doesn't seem as good to me. Where are we? So this is excused. I'm giving them a hall pass for this one. I think that there's reasons behind this that are not relevant to how good of a business they have. Unfortunately, timing-wise, they did all this borrowing, did all this spending, and so on and so forth. They figured, oh, we'll get it all back next year. Oops, now you're not getting it back next year. Now there's a virus and so on and so forth. But still, it's a sound, solid business, and I don't believe they're going to go back to under $4 billion in earnings. This year, yeah, they will, because quarterly it's going to suck because it's a terrible year. But that's true for everybody. You can't possibly blame them for that. But on the whole, I'm pretty sure they're going to keep earning $4 billion. But the thing is, now I say, oh, okay, well, so how much exactly? Ugh, that's not right. So now, does Yahoo work this week? Probably works better than PhilStockWorld. All right. Remember last week, Yahoo was slow. Now PhilStockWorld is slow. I wonder what that's all about. Are we up again? Are we good? Yeah, see, that's so annoying. Yeah, no problem now. I hope people were able to get into the webinar. I mean, obviously, some of you guys are here. Let's see what are people saying? Nothing. Okay. Tapes? I don't know what he's talking about. Okay. Jean-Luc, I have no idea what you're saying. Where are we? Yahoo, right. So if I put in WBA, I say, oh, we're only paying $30 billion, $31 billion for $4 billion in earnings. Would I pay 31? Now, the quarterly, not so hot. So quarterly, where the hell's the income? I hate the way they do this. The quarter chip. So they made $1 billion, then they lost $1.7 billion. They're probably going to lose some more money this quarter, and then they're going to go back to making $1 billion a quarter. They're still, but the point is going forward, they're $1 billion a quarter. They took a loss. I understand that's bad, but there's a reason they took a loss. It's not for nothing. So they're going to go back to making $1 billion a quarter. I can count on the $4 billion going forward, and that is sustaining my $31 billion investment. That means the PE is roughly 8. So if the PE is 8, it means they're returning 1/8. Okay, so 1 divided by 8 is 12%. So I'm getting a 12% return on my investment annualized going forward by putting my money into Walgreens, plus the bonus of them potentially growing down the road, plus they'll keep up with inflation, plus they pay me a 5% dividend. So do I want to own Walgreens stock, or do I want to put my money in the bank? I would rather own Walgreens stock. Therefore, I am happy to aggressively sell puts against Walgreens stock, because I may be forced to buy it at a low price, which lordy, I don't mind. If I sell the $30 puts for $4, what am I netting in for? 26. Where are we now? 35. That's $9 less. It's like 33% less than where it is now. So I can collect $4 for the 30 puts, which is 12% there in 18 months. So remember, I want to make 12. Now, so if I think about it, if I own the stock, I'm going to get a 12% return on my capital. If I don't own the stock, but I promise to buy the stock for a 30% discount, I'm still getting a 12% return on my capital, on my non-capital that I don't even actually spend. So that is a good one. Now, since I think they're ridiculously underpriced, I would be more inclined to sell the 3750 puts for $8. If I sell the 3750s for $8, my net is $25.50 basically. All right, so would I pay $25.50 for the $35 stock and take a $10 discount? Absolutely. Absolutely. I don't need to pay 24, I can pay 25. So I can collect more money by promising to pay 25 than I can by promising to pay 26. So you always have to look and think about what you're doing and what the net effect of what you're doing is. Oh, I'm sorry, that's 30. It's not 25. I apologize. It's 30 net. Well, 29.50, whatever. It's 29.50, not 25.50. So am I willing to pay $29.50, or do I really feel strongly I want to pay 26? If I'm worried, I'll pay 26. If I'm not worried, I'll pay $29.50. I'm not worried, I'm happy to pay $29.50. So I sell the 37.50 puts. That would be my logic. Now, what was my logic at the time? I sold the $45 puts back in March. I felt that was a fair price. I sold it for 11. What was my net? What was my net selling 35 for 11? It was 24. 35. Oh, sorry, 45. I keep doing that. It's 34. My net was 34. I decided I would be happy to own 2,000 shares of Walgreens at 34. How much is Walgreens now in this crisis? 35. What did I consider a very cheap price for Walgreens? 34. I was happy to own it for that price. Am I happy to own it for this price? Yes. Am I recommending it to everybody now? Yes. Why? Because it's a good price. It's now at the price I wish I could have bought it for, which is what I sold the puts for. Nothing here bad has happened. As far as I'm concerned, none of this has been bad. You may be sitting there thinking, oh my God, look at my puts, they're down 21% and I lost whatever. So what? It's only now at a price that I wish we could have bought it for back in March. We can now buy it for that price. I'm thrilled that we can buy it. I would love to own it because I can buy it for net 34. Right? Can't take that away from you. I got the 45 put. They paid me 11 bucks. My net is 34. I could buy it for net 34. I can exercise that put right now. I can sell the $35 puts for $6, and that would bring my net down to 28. And then I could sell the $30 puts for $4. That brings my net down to 24. And if I'm assigned, I'll have 2x at 28. That's my worst case scenario is 2x of Wal, is 44,000 shares, 40,000 shares, 40,000 shares of Walgreens. No, not 40. 4,000 shares of Walgreens at $28 a share. That's my worst case scenario. It's not a worst case. I don't consider that a bad case at all. I'm very, very happy to own Walgreens for 20 more years at $28 a share. I think that's a great base. I'm going to get a 5% dividend. I'll be able to sell calls against it. Great stock. Do I still like Walgreens? Yes, absolutely. No question about it. Ridiculous not to own the stock at this price. So you say, well, Phil, why do you keep recommending it when it keeps going down? Because it keeps becoming a better price. All right. You know, most of you guys are happy with your homes, right? You buy your home for $500,000 and there's a financial crisis and somebody goes to you, oh, you know what? Your home's only worth $300,000 now. Do you panic and sell it? Or do you say, God, can I really buy another house just like this for $300,000? You know it's a good house. You live in it. You like it. You paid $500,000 for it. Not necessarily, some people pay too much because they're suckers, but not necessarily because you're a sucker, but because when you bought the house, you said, this suits my needs, suits my financial ability to own. It fits in my portfolio of assets. It's something I will raise my kids in, possibly retire in, and eventually I hope to make money selling it. But if it suddenly goes down and somebody tells you it's only worth $300,000, you say it's only $300,000 if I sell it. If I don't sell it, it's still the same house with the same mortgage and the same everything else. Okay, Walgreens is still the same stock, paying the same dividend, and having the same long-term prospects. It's just currently priced much lower. That doesn't make it worth much lower. It's priced lower. And you've got to learn the difference. To be a good investor, you've got to know the difference. Just because someone tells you something isn't worth something, if it's worth it to you, you don't care what they say. Buffett tells you this all the time. Warren Buffett could not be more transparent about his strategy or what he's doing. He's like, this is out of favor. I like it. I think it's good for the long term. I'm going to buy it now. Why does he buy something? Because it's having a bad patch, but he thinks it's still a good business. Most of the things he buys in his portfolio, he buys good companies that are going through rough times. Because he says, okay, they did this wrong, they made this mistake, they learned from their mistake, they do this and that. Does he always buy perfect things? No. Buffett bought GE, Buffett just bought all the airlines last year thinking they were going to turn around. Obviously, nobody could have predicted this was going to be a disaster, but he has even said on multiple occasions he shouldn't own airlines. But he chose to violate his own rule, and now he's suffering for it. Nonetheless, Berkshire had a lovely year, so that hasn't been a problem. Bernie said Gilead spread looks in trouble, but it's not in trouble, is it? It's not in trouble at all. It's exactly on target. So how can it be in trouble if it's exactly where it's supposed to be? Short-term portfolio has a short on CMG expiring in September. Might be a candidate for adjustment. Let's take a look. That's a good one. Yes, that in chat. I didn't get a chance to answer it. Actually, I did get a chance to answer it, but then got the thing closed up. So in the short-term portfolio, now this is slow. This is not like virus traveling around the web or something. Although we often have problems with this particular thing. Wow, 2 o'clock already? I'm sorry. Wow. Time does fly. I gotta do the short one today too. Don't have a lot of time. Well, one day maybe we'll find out what's happening over there. Meanwhile, I'm gonna forget what I even was looking for. Oh, short-term portfolio. There you go. Holy crap. Are we still working? Yeah, it's still up. Let's see. PhilStockWorld. Yeah, weird. Oh, there it is. Finally came up. All right, so short-term portfolio is now 350%. CMG, another short, kind of like Tesla. And in this case, oh, we are getting killed on this one, but we already took profits off on something. I think we had the long, I don't know what we had. We had something, we made money, we took it off and we broke it up. So what we now have is a $950 put. That's, I'm sorry, the short calls. It's the short calls that are expiring in the September 1050s. And they're down considerably. They're up to 283. I thought CMG would pull back, but it never did. CMG. Holy crap. So nothing seems to stop these guys, unlike Tesla, who got stopped very harshly. But I'm not really worried about it, other than those puts are going to waste away. So we got to do something about that. But what did we have? We had the 950 puts, lost money on those. Now we got the 1050 call, CMG, And here's the question. So it's a short September 1050s. CMG. I think CMG is also ridiculously overpriced, but not as bad as Tesla, of course, so it's not a guarantee. And the September 1050s are 280, let's say. So it looks like 280. And so let's say, well, what's 280? If I go to January, what is 280? And it turns out it's the, that's not good. Looks like the 1100s of 280. So we can roll from 1050 to 1100 and pick up $50, but we're a long way from safe there. So like Tesla, we're going to end up doing the same kind of thing. We're going to sell some puts. And let's say, for example, we sell the 1100 puts for $50. All right. Now, instead of rolling to something that is, was it 300? Nope, the 1100s, right? Damn it, 280, right? So instead of rolling something for 280, I sold $50 worth of puts, so I can roll to something that's 230. 230 puts us all the way up here into the 1160s. All right, so now we're getting a little bit more reasonable. And don't forget, this is only a roll of September to January. So we're only rolling October, November, December, January. So we're only rolling 4 months. So in 4 months, we're rolling from the 1050s to the 1150s. If we pick up $100 every 4 months, eventually we should be able to get ahead of CMG, right? Unless they're going to keep climbing like 10% every 4 months, we're going to eventually hit a down patch where we cash out. Then we have to worry about the puts, though. That's the only trick to that. So some combination of doing a roll like that and maybe possibly adding a couple of shorts, which is what we did in Tesla, which is also how we got in trouble with Tesla. I don't think CMG is going to pop the way Tesla popped, though. But we got in trouble with Tesla because we had too many, because we did what we're supposed to do, though. What we're supposed to do is roll to a higher number. Let's say we go to March, and what's 280 in March? In March, we've got the 1135 call. So in 6 months from now, we could be at 1135 without selling puts. If we also sell some puts, and again, let's just sell whatever we can sell for $50. So we can sell the 1025 puts, which are nicely out of the money. We sell the 1025 puts, and that gives us 50 more bucks to pay with. So instead of 280, we need 230. 230 brings us here to the 1200s. So in 6 months, we can go to the 1200s, picking up $150 against CMG. And then all CMG has to do is pull back $150, and we're good. So if CMG pulls back 10% between now and March, we get all our money back. But now let's say it's how many options was it? Oh, it's only 3. So yeah, I'll go to 5. So let's say we go to 5. Now we need a calculator again. So we're out 300 times 280 is $84,000. So instead We divide that by 500. Now we can sell something for 168. What's 168? So I can sell 5 of the 1320s. We're at 1320 right now. So we could sell 5 March 1320s, push $250 up in price, or $270 up in price, not sell any puts at all. And now CMG is there. And we do that, I'm doing that in a 6-month roll. So 6 months from now, we can go to 1,600, and 6 months from then, we can go to 1,900. So do we pursue this strategy? Well, if we don't believe there's any possible frickin' way that CMG is going to be at 1,900 in 2022, then sure, why not? But that's the difference between a value investor and a TA investor. A value investor is going to be willing to say, it's not worth it. I am sure it's not worth it. I am positive. I don't feel scared of doing that. Just because it did go up in a crazy way doesn't mean it can keep going up. That's what we were talking about physics last week, right? Just because it went from 900 to 1,300, which is a 50% increase, going from 1,300 to 1,900 is another 50% increase. I don't think it can do that. I don't think it can go on the same earnings. And it goes back to the same thing. It's not just off the top of my head. 900 to 1,800, that's 100% gain. I don't see that happening. We're not betting it's going to happen in one shot. I'm saying in 2 rolls from now, I'd have to roll here, and it would have to sustain this until March, and then in March I'd have to give up and roll it up again to the end of the year, and then I'll be at 1,800, and I'll be saying it's not going to make it to this spot in this amount of time. Now, why am I saying that? Well, it's at 900 now. It was at 900 last year, basically. Then I go back to my money. And I say, well, okay, how great are they doing that they've doubled up since last year? So sales were 4 billion. You know, they have their problems with the killing people and everything. So 4 billion, 4.5 killed some people, 3.9 goes right back to 4.5, 4.8, 5.5. Great. So good growth, earnings, income, net income. Earnings, very bad, obviously, but we'll, you know, again, this is where you say, I forget that and invest in them. We were buying CMG back here. But 475, so we get 475, but let's say that's their potential if all's going well. It's 10% to the bottom line. So they go 175, 175, 350, very nice big gain. So 350 out of 5, though, still not even 10%. They still haven't gotten back to making 10% bottom line. But you could say, well, okay, so they will get back to making 10%. They're going to be good for 550. Maybe, let's say they keep growing this fast. Let's say 600, 700. So let's say they're going to get to 700 million in net income. Well, that's pretty damn good. How much am I paying for $700 million in net income? And again, this is potential given a rosy scenario. $38 billion. Still paying 38 times earnings if they more than double where they're at now. I'm saying that they're going to increase their revenue at the same pace they're increasing it now. I'm saying that they're going to not only increase their net income, but also do it at a much faster pace because they're going to get back to 10%. And then what's going to happen? Then they're going to be only 38, 40 times earnings. And it's 40 because it's only 700 out of 38, not a billion out of 38. So if everything goes perfectly, they're going to be trading at 40 times earnings. Currently, they're at 140. In reality, they're at 140 times earnings. That's ridiculous. 140 times earnings. McDonald's, who CMG spun out of, 34 times earnings. And that's an all-time high, by the way, the ratio. Cheesecake Factory, not really a comparison, but you know, oh, can't do it. Yum Brands, let's say Taco Bell. I don't know, where do we compare Chipotle on a scale? I think you got to compare it to Yum Brands. I mean, it's fair. 28. All right, Sonic. Oh no, that's not Sonic. SONC. Sonic. What happened to those guys? Ah, oh well. So let's say they're like Wendy's. Wendy's at 46 too. Wow. But again, Wendy's probably because they have odd earnings or something like that. Okay, let's see what happened to Wendy's. Wendy's used to be one I bought. They were on a watch list about a few years ago because they were so cheap. Now they're too expensive. Look at Wendy's. No earnings growth, no revenue growth at all. Income 120, 160, 130, 200, 460. What the hell was that? They must have sold something. So I would say throw that out. 140. So they're good for 140, 150. They're good for, just like any restaurant, they're good for 10% to the bottom line. Yeah, they are trading way too high. So I guess on the whole, a lot of stocks in the restaurant sector seem to be overvalued. I think what's happening is the money is going from the restaurants that have sit down like Cheesecake Factory. The money is going away from them, the investment money, not the consumer money, but the money is going away from those companies and towards takeout companies. And so takeout companies are currently overvalued. When the virus ends, everyone's going to say, oh my God, these guys are overvalued and the restaurant stocks are undervalued. The regular restaurants are undervalued because now people are going back to restaurants. So, you know, I can see that coming now. I don't know when the virus is going to end, but I can see the variables, and the variables are the people who have money in the restaurant sector are putting it into the people they perceive as being virus proof. But CMG isn't really virus proof. They're growing, yes, partially because they're pushing their takeout and doing a good job of it, but also partially because they're just bringing back to the normal growth that was interrupted by the poisoning of people that they did back in a couple of years ago. Now they stopped poisoning people, things have got back to a normal growth path and they're doing well. But it's not going to keep going this fast. You know, if they're growing here, let's say here you go, 10% growth. I wouldn't even call it 20, let's say 20% growth. So 20% growth, 20% growth, 20% growth, 10% growth, negative, back to normal, 10% growth, and not even 20% growth, 15% growth. How are they going to get to 7? If they 20% growth from here would be 6.5, another 20%. So 2 more years of 20% growth, but the profit has to grow astronomically to catch up. So it's not going to happen. And even if they do that, they're still trading at 40-something times earnings. So no, they're not worth now $1,300. They're not worth that now. They're certainly not worth $1,900. That's no chance in hell are they going to be able to justify that number. Same thing happened to Tesla. You get to a point where you can't possibly justify the earnings. I mean the valuation, and people start leaving. People start talking, and any little thing can knock you down. Doesn't take a lot. If you're that overvalued, anything can knock you down. And if you're a fundamental investor, that's what you do. You put your foot down, just like we said over here. So these are all good shorts. Look what's happening. There's a certain point. There's a point at which you can move because it's inside the channel. Like if you're a fish and you're swimming in a stream, right? You're swimming. You can go here and you can go here. It's deeper here. But if you don't mind going by the rocks or watching or getting too close to the kids with sticks, you can go over here and you can go over here. These are both places you can go. Can you go here? No, that's a highway. You're a fish. It's fundamentally not possible for you to go from here to here. Not without what? Stimulus. Somebody's got to carry you in a bucket or throw you or something. You can't do it on your own. It's not a thing that's going to happen. All right? Tesla is a stock. It's worth between this and that. Chipotle's a stock. It's worth between this and that. Can it get to here? Can it get to here? Sure. Something could happen outside of the normal parameters of fundamental business and can cause it to happen. What could happen? Crazy stimulus. Maybe one of their competitors goes bankrupt and changes the underlying fundamentals, but that wouldn't really be outside. That would just change the fundamentals. But within the fundamentals, something exogenous has to happen, like a stimulus or a very bad event. Elon Musk dies, whatever. something happens that drastically alters the stock suddenly. All right, the Congress removes the subsidies on vehicles. China puts on a massive import tax. In other words, something would change drastically that would cause them to go above or below the line. Otherwise, they're going to drift up and down in the range of conceivable value. The range of conceivable value is me saying Chipotle. I'm saying, okay, so they're going to grow 10% a year, and you'll end up here. If they grow 10% a year, I can see them going here. If they grow 20% a year, I can see them going here. If they go flat, then they're going to be here. And if they have another outbreak of E. coli or something like that, they could go right back down to the bottom of the range. But even at the bottom of the range, there's a point at which I'm going to start buying them, because I'm going to say, even though they killed a few more people, I still think people are going to keep coming back. All right, because they just don't stop. Jack in the Box had a bad E. coli thing. Jack in the Box had a very bad E. coli thing in New York when I was a kid. We used to love Jack in the Box because they had the clown, and there was nothing to do in the 60s. So in the 60s and 70s, that was entertainment for us. So we would go and order our food from the clown, which was like on a big metal head on a spring thing, and you're talking to the speaker, and that's how you did your orders at Jack in the Box. And we used to love Jack in the Box, and I was very upset because apparently they killed some people in the New York area, and I didn't care. Didn't bother me. I wanted to go back to Jack in the Box, but they closed Jack in the Box. They closed all of Jack in the Box on the entire East Coast, and they retreated to the other side of the Mississippi. But they thrive over there. Nobody there knows or cares whether some New Yorkers died of food poisoning. Jack in the Box is hugely popular in the West, non-existent in the East. So that was part of my logic when Chipotle had the E. coli thing. I'm like, it's a regional thing. I know it seems like a big deal, and the way news is these days, that's something that happens. Back when I was a kid, I know people I ask now, and they say they never heard of this thing that Jack in the Box killed some people in New York. They have no idea it happened. People in the West Coast and stuff. It just never existed as far as they know. These days, though, if anybody in Boston gets sick, everybody in California is talking about it the next day or the same day, or while it's happening, as they're throwing up at the table, somebody's taking a video and it goes viral in 30 seconds. News is different and everything's different, but the reality is people aren't that different. People are still going to be like, didn't affect me. And you do it all the time. There's a shooting here, there's a shooting there. Do you not go there anymore? Do you put that city off your checklist? You go, no, didn't happen to me. People getting shot in the streets. Somebody gets shot in the streets. I don't want to say Chicago, because Chicago, I think Trump just keeps saying Chicago. I think everything in Chicago. But over the weekend, there was some kind of shooting on the streets, and it might have been Brooklyn. I mean, there you go, Brooklyn. Right? It might have been Brooklyn. My daughter and I were just talking about the best pizza places in Brooklyn after I'd seen that happen. So in fact, I do think that might have been the case. But anyway, somebody gets shot. Like poor guy was sitting in his car, got hit by a stray bullet from a gunfight. Like ridiculous. So it doesn't stop me from going to Brooklyn, and it wouldn't stop me from going to Hal's Pizza where it happened or anything like that. A thing happened. What are you going to do? It happened, and that's how people are. So over time, people forget, people start going back, so on and so forth. All right, it's not going to, people's habits don't change that drastically over small incidences. So when something bad happens, like when BP went down, we bought BP. With various crises and things that happen, when Chipotle went down, we bought Chipotle. Things go out of favor. When IMAX went down, there you go. There's another one I recommended recently with IMAX. Because IMAX is down because nobody can go to the movies. Is that going to be the permanent situation for mankind from now on? No. Are people going to not want to see great big screen movies with giant speakers and all the surround experience and all that crap? No, they're still going to want that. Still can't get it in your home. That's why I like IMAX. Can't do that at home. You can do a lot of stuff at home, but you can't do IMAX at home. So, people still like that. It's still fun. It's still a good thing to go out. People may go to movies less often, but IMAX has been doing really well. And IMAX is very, very cheap still. Where is that? Charts. Wrong chart. IMAX. Having obviously terrible year, but they were climbing nicely, and now they're coming back down again. I want to buy them again. This is a channel that's rising. It's a nice rising channel. They're coming back, and they're going to get back into the 20s eventually. But when the movie's fully open, by the way, IMAX movies, other movies in China and Asia have been open. They have not had any super spreader events at any cinemas. So there's been no movies so far, and it's not robust, of course, and they're only half filled and whatever. But the bottom line is they haven't had any of these super spreader events in any of the movies. They've not traced anything back, so they keep going, and they keep opening more now, because so far movies have not been a cause of a massive spread. People have to sit there and wear their masks, but apparently if you wear your mask and you don't sit right next to other people, it's generally a pretty safe thing, apparently. And as that becomes more of a thing and people realize that, people are going to start going back to the movies, and movies don't have to be full. Anybody who goes to the movies knows this. Theaters don't have to be full to make money. I mean, it's weird because, like, you sit there and you go, I never go to the first week of a movie. I don't even go to the second week of a movie, but like I'll usually try to catch a movie the third week or the fourth week, you know, because I don't want to sit there with 50 people or 100 people. I like to sit there with 3 or 4 people in the audience, so it's quiet and I can watch it and nobody's around me, and I can spread out and I can have my popcorn on one side and soda on the other side, using up 3 seats for myself. I like that. Even if I'm with people, my kids have to sit. I don't usually have my kids sit right next to me. I'm like, I want some space. I want at least space on one side of me so I can put my drinks and my snacks and all that and hang out. Because that's how I have fun. That's how I enjoy the movie. Anyway, so I like to go to empty theaters and watch movies. No, but because of that, I always pay attention, because the bottom line is, you go to these movies, they're running movies all day long, and most of the theaters are half empty at best. So all we're doing is we're forcing by saying you can only be a half full theater, what you're doing is you're taking the generally crowded theaters at opening nights and you're spreading them across more shows. So they'll either run longer in the theater to get so that everybody gets a chance to see it, or they'll show them in more different theaters at more times and maybe have extended showings, extended times and whatever, but they will seat just as many people. And so I'm warming up to like AMC and Cinemark as possible things to invest in, because I think that they're going to come back. And AMC's already, I don't know if that's AMC Theaters though. I know CNK is Cinemark. That could be AMC, the network. So Cinemark is a very good chain, good movies and whatever, and they're very beaten up. They never recovered at all from the virus. I think this is probably, we got to look carefully at like their structure and how badly financially this is killing them. But going forward, I do think that these things are going to come back. I think they're going to be a good investment down the road. So we will see what happens, but that's going to be interesting. So I thought about it logically as far as from a theater, can they still make money? Because that's what people are doing. They're pricing it like they'll never be able to make money again. That's not true. This will all be over next year, for one thing. That's number one. But number two, even though it's not over, they're going to start creeping up, because you don't need to fill the theater to make money. It's only the way it works in the theater now that they have these things where on Friday night it's completely packed and everybody wants to see the Avengers on the first night. But now it's just going to be sold out, and you're going to have to wait till week 2 and week 3 to see a blockbuster movie. You won't be able to run right to the theater and see it. You're going to have to wait until there's more tickets available. And it's not much of an adjustment for people, because tickets sell out now. It's not a drastic adjustment in the way people see movies, because you right now can't see a blockbuster movie the first weekend. It gets sold out, or as I say, I don't want to deal with it. If I'm going to have all these people around me, I'd rather not go. So I think that that's going to come back better than people think. I think they're really underpricing it, and especially though, like I said, IMAX, because it's a more unique thing, and they have a different structure, and I think there's a lot, and they're heavily exposed to Asia, where they've got the virus under control, unlike America. So that's all that. All right, I only have a couple more minutes. I gotta go. Let's see. What do we got going on here? Oh my God, look at this essay. Sonic was acquired by Inspire Brands, Rick says. It's owned by Rock Capital. Rock is an American PE firm with over 1350. It is named for Howard Rock, the protagonist in Ayn Rand's novel. The firm claims that it is not meant to connotate any particular it's not meant to connotate a political philosophy, but instead signify the firm's admiration for the iconoclastic qualities of independence and selfishness. Well, isn't that, okay, I'm sorry, because nobody else can see this. The firm claims that its name is not meant to connotate any particular political philosophy, but instead signify the firm's admiration for the iconoclastic qualities of independence and self-assurance embodied by the central figure in the fountainhead. That's a political philosophy. That's ridiculous. You know, I'm not espousing any particular philosophy, but you know, good, I can't even think. All resources must be shared. You know, I'm not a communist, but I just think everybody should share everything, and all resources should be distributed equally by the state. Don't you think? You know, not political, just the way I feel. I think that's a really thin argument. Anyway, so there's that, and I am going to wrap this up right about now. So we'll see where we are on the indexes. It's not about whether we bounce. This is a quick bounce though, and we're right back to 34.20. But if 34.20 is a problem, we start falling off from there, then we are going to say that that's firming up as a ceiling, which it should be. The 20% line should be a ceiling. And this is with stimulus talk. So we'll see what happens as that fades out. And as you see the Congress revert back to its normal fighting and bickering, and people start giving up on the stimulus, we'll see how it actually holds up. All right, so what else happened? So one more thing, I'll check the oil report, although I really don't think much of it. Oh, sorry, what is oil doing? Oil came back nicely, actually, went from 36 back to 38. So that's good, but remember we were shorting at 43.50? I mean, crazy. Yesterday, I called for the stop out here. I said, this is low enough. Well, actually, I think I said 38.50, but 38.50 was low enough, or 37.50, whatever the hell it was, and we're done. We stopped out, and we said, you know, we set stops yesterday, and we're done with that trade. Nothing else is really exciting to trade. I imagine that we had a good draw on the oil report, otherwise it wouldn't be where it is. Refresh that. Check the date, August 28th. Oh no, there was no oil report. Oh shit. The oil report comes out tomorrow. There is no oil report until tomorrow.